All right, it is a risk-off day for bonds as well. The government reopens, and bond yields, they're going back higher, back above 4.1%. Let's get more now with Rick Santelli in Chicago. You can comment on the Fed, bond market, as you prefer, my friend.
Well, let's start with the 30-year bond auction. It was the last of a three-part series of Treasury supply releases. The 30-year, $25 billion, completed $125 billion of coupon supply on Monday, Wednesday, and today. Look at the 6-hour chart. Right straight up at 1 Eastern, rates popped. And if you look at a 2-day on a 30, they popped above yesterday's high yields. And if you bring in the whole gang, 2s, 10s, and 30s, you can see the entire curve's rates are up a bit. They spiked on those results. They eased back, and they're back towards the high end. Maybe the big story, as Brian pointed out, is the government, well, open. But traders don't care if the government's open. Traders care if the data's getting released. And that is the rub. Because many now in the administration have floated this notion that we're not going to get some of the lost data. I don't know how it's going to work out, but investors were not happy about that. They dragged the percentages for Fed funds for the December meeting under 50% because there's pessimism regarding the data. And there was that before they learned that they might not even get totally caught up on the data. So if we want markets to do better, the sooner any relevant data is released, I think investors will take that to heart. But ultimately, what we are seeing is still stubborn long-end rates. We're still seeing very discriminating investors when they buy supply. And I don't think either of those issues, Brian, are going to go away anytime soon. Back to you.
Well said, and a big debate certainly ahead when the data starts to roll out. Rick Santelli, thank you very much.